This has been a tough quarter for restaurants. Hello, this is Jonathan Mays, Editor-in-Chief of Restaurant Business, and welcome to the Week in Restaurants. I am joined this week again by Senior Editor Joe Guskowski. We are in the throes of earnings season, and it's been a lesson in, well, I frankly do not know, but it's been a lesson in something. Just about everybody is not doing well right now, and we will talk about why. But there are a couple of notable exceptions in Chili's and Taco Bell, and we'll talk about those companies. And then some big news this week out of Panera Bread. Later in Tech Check, Joe talks about Seamless. But Joe, let's start off with some of the winners. Let's start off on a positive note. Let's talk about Chili's again. I don't know how many times we've talked about Chili's on this podcast, and frankly mine, but it's somewhere in the neighborhood of 1 million times at this particular point. Tell me about what their quarter was like.
Yes, Chili's same-store sales soared 31.6%, and that followed a quarter in which same-store sales were up 31.4%. It was somewhat of a victory lap after that impressive quarter, and it's pretty much more of the same. I mean, they've really hit on something with these $10.99 value meals and the marketing around those. And then they had the viral success of the Triple Dipper and the mozzarella sticks that has carried on into the start of the year. They didn't do anything differently in the first quarter. You know, they're just kind of riding the wave of this newfound popularity that they've got. And now the challenge becomes, how do you top this going forward?
No, well, that will not be very easy. So like they were comping at 15% for a couple of quarters, and then it popped to 30+%.
They're lapping a 15%. This current quarter that we're in right now is going to be lapping a 15% increase. So we'll see. That should give us some hints about whether they're going to be able to do this.
I mean, probably not. I mean, it's you probably got to figure that their comps somewhere in the neighborhood on a 2-year basis is like 35%, I think. I could probably do some quick math while we're sitting here because I have same-store sales data. So, yeah, I mean, it's probably in the neighborhood of like 35%, Joel. And so, you probably can expect, assuming that they maintain this trajectory, probably somewhere in the neighborhood of, 17, 18% comps for like the next couple of quarters, unless they're able to do something to pull customers pull more customers in beyond what they've done already. The thing is, like these 2 quarters, those are not the 2 quarters that'll really be the test. It's once they start comping against the 30+ numbers. And, if they can maintain growth on those numbers, then that would be extraordinary, because you got to figure at some point, some of this social media stuff dies down. We do know that eventually, social media and so giveth and social media taketh away, Joe. And at some point, you just never know. But they're on one hell of a ride. And
go ahead.
Yeah, no, they're on a hell of a ride. They're doing things the right way. They're investing behind. I mean, your story pointed out that they're investing behind their service. They will invest behind labor. They will get things fixed. Doing marketing, paying off debt. They're doing all of that stuff before they do a share buyback. Now, eventually they'll do that because they're a publicly traded company, and God help you keep the same number of shares out in the open. But anyway, they're doing things the right way, and that's a good thing.
And yet their stock was still down 15% after this earnings, just a total head scratcher. But I think investors are seeing the challenge they have ahead to beat this performance.
Right. Well, I mean, there are a lot of reasons why stocks make moves that they do. And, ultimately a single day change is usually based on some sort of algorithm, and you have to wait after a while to, for that to really filter out, and then actual sentiment of investors takes over. But it's usually based on expectations. But there's another company, by the way, that also did well, and that's Taco Bell. Taco Bell is a more interesting case because Taco Bell's has done well for some time. On balance, they've been really, really consistent. And, we'll talk a little bit about the negative numbers here in a minute, but their sales results don't stand out as much as Chili's. I don't think anything stands out as much as what Chili's has done. But, they did a 9% comp last quarter. McDonald's this morning, the morning we record this, was down 3.6. Everybody else is down on the fast food sector that is reported so far. Wendy's, by the time any of you read it, maybe Wendy's is out and we'll see where they are. We don't have Burger King's numbers yet. And so there's a lot, but like KFC's down, Jack in the Box is down, Del Taco's down, all these companies are down. And then you got, Taco Bell just reporting a 9% comp number. And no matter what way you spin it, based on the current economy, on no planet should Taco Bell be doing 9%, but they're doing 9% because for whatever reason, they have a combination of marketing and food that just really apparently resonates quite well with the U.S. consumer at the moment, for whatever it's worth. KFC did -1, sister chain, Pizza Hut did -5, Jack in the Box -4.4. The negative numbers, by the way, have been awful. And yeah, I was looking at them. I think the only two positive, everything was at least the strongest concept outside of those two that have reported so far, both reported a 0.5 point same-store sales growth. And that's Wingstop and Shake Shack. But like Chipotle was down. That's probably the biggest eye-opener to me. Chipotle, because
they had been doing so well. They had seemed resistant to all this.
Yeah. Do you go to Chipotle a lot?
No, I don't.
To me, I was a bit surprised by that. And our colleague Lisa Jennings reported, using Technomic data, that they have a value perception problem, which kind of surprises me a little bit, because one of the things about Chipotle is you get a lot of calories for what you spend. You spend $10 at Chipotle, and you get roughly, you can get about the same amount of calories, Joe, as a Big Mac and a large fries. Which for young guys is a big deal. People like us, not so much. But like if you're a 20-something-year-old dude, you want the calories. And so the value perception problem surprises me. But the fact that they turn south is probably, if I'm a restaurant company out there, I look at those numbers and I get really worried about the balance of the year, frankly, because Chipotle has a higher end customer than your average fast food chain. And they've been resistant to everything that's hit them outside of E. coli a few years ago. But really the past 5 years, they've just done extraordinarily well, and suddenly they're not. So it's a tough market, I think, right now, on balance, outside of a few concepts.
That is really concerning. Although, if I recall, Chipotle and Wingstop both had incredible years last year to start the year. So is it possibly just a matter of tough comparisons with those two?
Comparisons are always a factor. They're definitely always a factor. And it's, in the first quarter in particular, is always one. Here's what I'll say. I think that there are a lot of other potential explanations for the frequency of negative numbers that we've seen. Leap day, for instance, Joe, there was a leap day in 2024. There was not a leap day this year, as is going to come as a surprise to you. But if you have one fewer day in the quarter, that usually means you're going to get less sales. So that's kind of how that works. Bad weather. There was bad weather in California and throughout the Southeast. We had some real bad winter weather in February. That definitely plays a role. So you could see that. To me, what's stark is the amount and frequency of commentary from executives. Cheesecake talked about it, didn't they? Cheesecake talked about it, about the consumer sentiment being a problem.
Yeah. Yeah. They lowered their outlook for the year, and they're just a machine. They're going to do, they might be flat same store sales for the year, but they're not going to probably be negative. But even they are sensing, some demand issues that go beyond weather and fires and holiday shifts. So it's definitely there. Absolutely. I think the first quarter, though, was, like you're saying, it was really a perfect storm of a lot of different things that are making these numbers look extremely bad versus just, a little bit bad.
Yeah. We'll see what the other companies report, but it's hard for me to look at the companies that have yet to report and not think that it's anything going to be but more of the same. We have Wendy's. you could see the way Wendy's had been going, Wendy's probably, Wendy's could easily outdo McDonald's, and you could see some growth out of them. I doubt it's going to be extraordinary. Burger King will probably be negative, and then, on the casual dining side, Texas Roadhouse, we'll see where they were, because as you reported before, they seem to have a tough early part of the quarter, but they usually kind of withstand some stuff. They'll be an interesting one.
Yeah.
BJ's reports, and we don't have those numbers yet, but they could be interesting. I mean, they should be a bunch of interesting numbers, but I'm guessing that it's just going to be more of the same. And then the big question is what happens in the second and third quarter, to me. Like if that kind of thing continues, or we see some generalized improvement. I think a lot of it's going to depend on what happens with the overall economy. Overall, the economy is on the decline, Joe. So the next thing, have you heard of Panera Bread?
I have heard of it, yes.
Yes. So our colleague Lisa Jennings reported this week that they are now going to close their fresh dough facilities, the remaining 9 fresh dough facilities. They have already closed a couple of them, laying people off, and they are going to go to par-baked bread from a third party. Yeah, they're also going to unleash like sort of a 3-year plan. I don't know what your thought is on that, Joel, but I have an opinion on this. It's Panera Bread.
Yes,
and bread's in your name. That par-baked bread had better be delicious. And I get concerned. I get really concerned anytime a company having issues, and Panera Bread's had issues for the past couple of years. I mean, their sales, I think, were down 4.5% last year. Total sales last year down 4.5%. They've been treading water pretty much since they were acquired in 2017 by JAB. And there might have been some growth in 2018, but they're roughly about the same size as they were before the pandemic. Whatever they gained post-pandemic is gone. They were going to go public. That thing, forget that. Forget any sort of go public move anytime soon. They folded in Caribou and Einstein, and now they were planning to sell it. Now we don't know what's going on with them. And they've changed management a bunch of times, and now they're closing their fresh dough facility. I get concerned anytime a company cuts quality, even if it's the perception. And they're supposed to be a quality concept. That's supposed to be they are one of the two. They are the second biggest fast casual chain. Used to be the first, and they're probably going to be third to Panda Express very soon. And I have some concerns about any company that diminishes quality in a market like this. It's and I could very well be wrong. It wouldn't be the first time, won't be the last, but I'm skeptical.
Yeah, I mean, the bread is their calling card. That's been their thing since day one. I think it's frankly impressive that they have been able to scale that to more than 2,000 locations. I mean, baking fresh bread daily is, I don't know, that's hard to scale, which is what we're seeing with this decision here to switch to a different process that they say will allow them to make sure they have that they don't run out of bread at the stores, which whatever, I don't know. But it's a questionable decision. It really is, to take your core tenant, your big differentiator, and basically throw it away. I guess the determining factor will be, like you said, the quality and whether the consumer will notice or care. And how much is this going to really help? Their sales were down last year. So how much is this going to really help your sales? And is it going to allow you to open a lot more restaurants? And is all of that worth throwing away what made you this unique brand?
Right. Yeah. I do need to correct myself, by the way. I'm looking at top 500 data, and they are already the third largest fast casual.
Panda
Express overtook them last year.
Wow.
Panda Express, by the way, one of the more appreciated restaurant chains in the United States.
Yes.
They just continue to do decent to well every single year. Up 5.3% last year, 2,500 locations, didn't blow the doors off the water. But on balance, it was enough to overtake Panera Bread. With on the Panera Bread thing, if you look at their sales numbers, their total sales were down 5.1%. But on a same store level, they grew unit count by 1.7%. So their sales actually declined on a same store basis, somewhere in the neighborhood of 6.8%. So Panera Bread has a challenge getting store sales into the stores. And my guess is what you're seeing here is a push to make life easier and deal with supply challenges like you said. But it's just not, if consumers perceive that your quality goes down, invariably that creates problems. It's been operated this way forever, and now they're changing it. So it's a big risk for them. Maybe it works and improves operations, but all their food, it should be better. It does remind me though, Joe, the one time I got some oatmeal there for breakfast one morning. It was at I can't remember. It might have been in Chicago or someplace like that. And I go to Panera Bread. I order some oatmeal, and it comes, and the top, there was a frozen puck of frozen watery oatmeal at the top. Because apparently they didn't, they didn't microwave it well enough, apparently.
That is a great point, because it's like they've been, I think, cutting corners for a while now, and it's not just the bread.
Mm-hmm.
So what makes them think, and they've been losing sales. So what makes them think that this move is going to help things? Right. I don't know.
Yeah. I mean, the issue and the thing is like the lessons that we've learned. And I think if we go back and you look at the concepts that have done really well, they all have a perception of quality. They all have a perception of quality. If you look at Jersey Mike's versus Subway, Jersey Mike's is easily outdoing Subway these days, probably somewhere in the neighborhood of maybe 5 to 7 years or something along those lines. They probably overtake Subway eventually. You look at the best, the best performing burger chains are Culver's, mine and your favorites.
Woo!
Whataburger, which is also excellent, and Freddy's and In-N-Out. And literally every other burger chain is just not. Well, I mean, Shake Shack did okay. Shake Shack did well. So I last year they did. And then everybody else, not so much. You look at Chili's performance was driven at least by a focus. The company is focused on quality. Quality versus price. You look at Texas Roadhouse, perfect example. Texas Roadhouse versus Outback Steakhouse. Texas Roadhouse has an infinitely better reputation in the market right now. Same as Longhorn, frankly. The Longhorn, not quite to Texas Roadhouse level, at least his reputation based on my perception. But, they both have a much better reputation than Outback. And a lot of it is based on the consumer perception of quality. When you start cutting the consumer perception of quality, that is a long-term net negative to me.
Yes.
And the U.S. restaurant business is entirely too complicated, too competitive to make sacrifices. So if you're going to make an operations-based change, like I assume this will, operations and financial change such as this one, you'd really better hope that the bread that you're getting is damn delicious and consumers don't notice the difference. Because if they do, they're going to hammer you for it.
Yeah. And I guess we should clarify, it's not like they're buying frozen bread. It's going to be their recipe, and it's going to be par baked. So it's going to, there's still going to be some prep happening in the stores. And I imagine those factories and all the people that work there, that's got to be a major cost for them. So, got to give them a little credit, but the perception is what is concerning more than maybe the actual change.
You know who bakes their own bread on site?
Well, I think Texas Roadhouse does.
Subway.
Of course.
They get the dough and it's frozen, but then they bake it on site.
Which is probably what Panera will be doing.
Par baking is par baked, so it comes par baked.
So it's not even frozen.
And that's, yeah, usually companies have their recipes, and then some other company does it for them, and that's so. To me, it can work. It can work okay. It can work fine. Anything, I could be completely wrong, and I really kind of hope I am, because a lot of people's jobs and livelihoods depend on it. But I just get the heebie-jeebies anytime anything like this happens. I really do. It's just not. It's not to me the way the industry should be going. You're a restaurant chain, and you had one way of doing things for years, and now you're essentially making a compromise. And again, there might be very good reasons behind that compromise. It better work. That's my view on it, Joe. But, you know, as I said, could be wrong. Been wrong before.
Yeah.
Not very often. And usually my wife is involved. So superb. And that should do it for the Week in Restaurants. Coming up soon, we have Joe talking about Seamless. But first, whatever ad Spoons decides to run this week.
Our industry is grappling with uncertainty. At the 2025 National Restaurant Association Show, you'll explore innovative solutions, strategies, and partnerships that will prepare you for whatever comes your way. Take it from me, the show has everything you need to elevate your front and back of house. You'll see, touch, taste, and demo the latest trending products across more than 900 categories, including food, beverage, technology, equipment, and more. Don't miss the industry's most trusted event taking place in Chicago, May 17th to 20th. Secure a badge by May 9th to save $30. Register today at nationalrestaurantshow.com. Rate quoted ends on May 9th and applies to operators only. Non-exhibiting suppliers are subject to a higher badge rate. Please check out the show's website.
Hello and welcome to Tech Check, where I, Joe Guskowski, talk really fast about one big topic in restaurant tech. This week, the delivery market has a frisky upstart. Well, sort of. That is, if you consider Seamless an upstart. The New York City-based delivery app, which is part of Grubhub, has been around for a while, but is getting a reboot under new owner Wonder. The revamp pits Seamless as a challenger against larger competitors DoorDash and Uber Eats in New York, and as such, Seamless is doing some interesting things like offering free delivery and selling $1 slices from a host of local pizza joints. It's also appealing directly to locals, for instance, with the new tagline, How New York Eats. It's a throwback to the days when there were a bunch of regional delivery apps before they were largely consolidated under a few national players. Free delivery and $1 pizza probably won't be profitable for Seamless long term, but the strategy could shake things up enough to shift the competitive landscape, at least in the restaurant mecca that is New York City.
And that should do it for the Week in Restaurants, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com. But please subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, the editor-in-chief of Restaurant Business. For Joe Guskowski, thank you for listening.